what I will do, I will have a dual mode. That means physical class as well as the Zoom, as well as the YouTube live, and then you see what is the best effect, okay? Okay. Now for this class, right, we have it's called investment portfolio management, and then we have a required text. So I'm not sure how many of you have already got this textbook. Okay, you can go to the library. I'm not sure whether you can go to the library and then you can see whether you can get. And then this textbook, right, is in fact for the CFA exam. CFA exam is a very prestigious exam for those people who are working in the research analyst or fund manager. They must have a CFA. So you can buy from Lazada. I think the cost is about 80 something for one book. And then all our chapters are all from here, okay? So this week we want to cover chapter 1, 2, 3. So if we cannot finish 1, 2, 3, right, on Saturday we will have to do extra class. So then I will have to ask you guys which time is, that you are free on Saturday. Then we will have like 4 classes combined together on Saturday to finish up at least 1, 2, 3, so that next week we can have a week 1 and week 2 tutorial together, finish in one class. Then the following lecture will be, then we can proceed so that we can have more time for the revision for the quiz, the test. The first test is on the 31st of March, okay, 31st of March, which is end of this month. So you do not have much time. So we must have a lot of practice before we can go for the MCQ. Because last year, remember, it was because you guys have a lot of practice on the MCQ, then you can score well. So if you do not have enough time for the practice, right, then you may not be able to score well, okay? So we must allow some time for that. Okay, Shirley is coming in, okay. Okay, so let's start. I'm going to share the screen and then we'll start from first slide. Just now the class, right, I was supposed to cover chapter 1.5, like chapter 1.5, but then we cannot even finish one chapter. So I think it's too ambitious to have to think about covering chapter 1, 2, 3 in this week. So I will try my best so that I will not go too fast and then everybody understand. Okay, the first few chapters are very simple chapters, simple concept about investing. Okay, so basically what we understand about investing, what do you mean by investment? You come to this class, you want to learn about investment. What is investment to you? What do you think? What is investment? Investment is what? What is the characteristics of investment that you know? Oh, so this is an investment. What is it? Make money, right? Okay, you are on the right track. So that means investment is something, an instrument for you to make money. Okay, but in finance, the definition is that you need to sacrifice today's consumption to get future higher consumption. Okay, so that's investment, the definition of investment. That means you need to sacrifice today's consumption in order to get more of future consumption. So what it means is that when you want to sacrifice today's consumption, that means what? That means you cannot spend. If you cannot spend, then what do? You save money. So you save money in the form of investing. You invest in asset. It could be a property or it could be a stocks. Okay, you invest. So you just think about it. If you do not spend, you save. So by investing, you save money, and then in the future, when the investment increase in the value, you can have more return, and then you can spend more, you can consume more. So that means you are delaying your consumption to the future date. And so this is the essence of investment. Okay. So all right. Then let's take a look at the next slide. what is investment? So this is what I said just now, alright? So I don't want to spend too much time on this. I'll go into the next slide. So basically, financial assets are real assets. So financial assets are claims on real assets or real asset income. So what it means is that these financial assets, they can generate income for you. Okay, anything that can generate income for you, the assets, you can say that as an investment. Okay, if it doesn't generate income for you, most likely this doesn't fit into the definition of investment. Okay? Okay, so then these asset classes, basically there are three big categories. Okay, three big categories of the asset classes. You have the common stocks, which is the stock market, the stocks. And then you have the fixed income securities. Fixed income securities meaning that these are the bonds, okay, those fixed income instruments. And then you have the third class, asset class is called the derivatives securities. Derivatives are like futures and options. Okay, last year we have done these futures and options, right? So basically, these futures and options is like it's an exchange. There is a market for them for itself. Okay, there is a market, but this market, right, is buying and selling of futures contracts only. Contracts. They are buying and selling of the contracts. They are not buying the real thing. For example, you are looking at the CPO, the crude palm oil. So you know the crude palm oil, you are looking at the fruits and those oil, right? So if you are looking at the derivatives market for this crude palm oil, you are just buying and selling of the contract for the delivery of those crude palm oil. Okay, the contracts only. So therefore, this derivative market is more like a secondary market like that. It's not the main market. Okay. All right. So then talk about the financial market and the economy. Whether the price that you see in the stock market, the share price, right? Is it a fair value? The market price. So then this slide says that this market price, is it equal to the fair value? Question mark. Okay. Do you think the share price that you see in the stock market is a fair value? What do you think? Yes or no? No, because what drives the share price? What do you think? What drives the share price? Is actually the fundamental that drive the share price, and then at the same time, the demand and supply also drive the share price. So we are looking at two things here. One is that the fundamental of the company, the valuation of the company that drive the share price. If there is good fundamental company, it will drive the share price up. Okay, that's number one. And then number two is because of the demand and supply. That because people buy and sell in the stock market, so the demand and supply that drive the share price movement. Now, is it possible that you have a company with no earnings, but the share price is like skyrocket? Is it possible? That this company no earnings, right? But then the share price is skyrocketed. Is it possible? Yes, it's possible because it's demand and supply, right? Because there are two parts of the equation. One is the fundamental. So if let's say the investors do not want to look at the fundamental, they bypass the fundamental, then they just want to push up the price, so they keep buying it. Okay, they keep buying it, and then that will push up the price. So therefore, it can happen as well. Okay, and it can happen the other way. It's a good fundamental company, but everybody is selling it. Okay, so therefore it can happen the other way. So then sometimes it doesn't reflect the fair value. Okay, so do markets allocate capital to the best use? In theory, markets should allocate capital in the best use, in theory. Okay, but very often we do not see that. And that's because of the individual motives behind the stock market, because there are a lot of motives, you know, the psychology behind it. So sometimes the price of a certain stock is being pushed up to a very high level, and it doesn't reflect the fundamentals. So therefore, in terms of the stock market, in the real world, it may not be a good way to allocate the capital funds. But however, in theory, it's supposed to be a good way to allocate the funds, because in theory, if you are making good money, if the company is making a lot of money, then investors should be pouring in the money into this company. you should buy this company, okay? But sometimes things may not happen that way, okay? But most of the time, it should be happening that way. Okay, let's put it that way. Okay. Then this slide is talking about consumption timing. So we are delaying the consumption to future so that we can consume more. Okay, by transfer of the consumption to the future. Actually, investment is a store of wealth in the middle, in the process. It's a store of wealth so that we can delay to the future and then we can consume more. Then slide number 7, we talk about the risk allocation. Now for risk allocation, right, I want to bring you the idea of risk preference. Okay, risk preference. The word risk preference means your preference about risk. How you want to think about risk. Like, do you want to embrace risk and then you take on more risk, or you want to avoid the risk? So what is your preference? So how many of you are scared of investing? Like you are scared of losing money. How many of you? Okay, most of the girls are scared, very scared of investing. But the boys should be more risk lover. You like to take on more risk, right? So most of the time we see that people who are investing in the stock market are usually male. Female are lesser. The girls are lesser. Now the reason is because it's a character. It's your risk preference. Okay, it's boiled down to this risk preference. That means if you do not like to take on more risk, then most likely you will avoid the stock market and then you will invest in bond instrument, bond funds, or fixed FD or whatever. But if you are more into the risk, right, then you will buy penny stocks, you will buy cryptocurrency, you will buy forex, you will buy, very high risk and of course high return and of course high loss as well. Okay, never mind. We can all learn from this class. Okay, this course we are going to talk into the bond valuation, how you value the bonds, and then we will look into the equity market, how you value the equity market, and then the derivatives market, these 3 markets in different chapters as well. Will be the later chapters, not this chapter, later chapters. And then we look into how we manage it. And then also remember there's one assignment, and that assignment is on the calculation on the Excel worksheets. A lot of calculations for this course. Okay, so you have to have your mind, prepare yourself that you'll be going through all the Excel worksheets and the calculations. Okay. Okay, so then let's take a look at this slide number 7 now. Between the bond and the stock, which one is more risky? What do you think? Which one is more risky? Between the bond and the stock. Stock is more risky, okay. Between the bank FD, CD, bank CD means bank FD. Between the bank FD and the company bonds, corporate bonds, which one is more risky? The girls? Between the FD and the company corporate bonds, which one is more risky? Corporate bonds, okay. So is there always a risk and expected return trade-off? So what it means is that whenever we want to have a high return, then you have to take on more risk. Okay, high return, high risk. And then when you want to have a low return, low risk. So is it possible that sometimes you will run into high return but low risk? Or the other way, low return but high risk? Is it possible? Yes. Give me an example. It's possible. Okay, usually what we see is that, okay, you must invest in a high risk one so that you can have high return. That's a norm. Like everybody know about this. High risk, high return, high risk, low return, low risk. If you do not want the risk, then you just put in the FD and then get the low return. Then the question is it possible that sometimes the risk is very low? You can have a very low risk instrument, but the return could be quite high. High as in not too bad lah. Is it possible? Yes, it's possible. So for example, nowadays the borrowing rate is very low. The cost of borrowing is very cheap. The OPR is 1.75. Your FD rate is about 1.7 or 1.5. So the cost of borrowing can be very low. So what people do is actually they are looking at borrowing at a very cheap loan, maybe 2 or 3% cheap loan, and then they invest in a fixed income instrument like 5%, 6%, that kind of bonds. Okay, because some bonds, corporate bonds, good corporate bonds, they guarantee 5-6% of return. So you just imagine you borrow money at 2-3% and then you invest in the fixed bond with giving you 5-6%. Net how much you get? Net about 3%, 2 to 3%. So then this one is like almost like risk-free, almost risk-free, because bond also have a risk there. So almost risk-free. So you can have this kind of return. Okay, low risk but high return. But then at the same time, you can also have high risk, low return. For example, if let's say you invest in the property stocks or REITs, these property stocks, maybe now you don't see the outlook is good for these property stocks, so you may see that the return is very low, but the risk could be high. Okay, so these are the things. Then the next is the separation of ownership and the management. So if you look at the stock market, right, these public listed company, they are actually, we have all the shareholders that own these shares, right? Shareholders. So we call it the owners or the ownership of the company. Then on the other hand, you have the management that run the company itself, the management. So usually the management are hired by the big shareholder, they hire the manager and then that will run the company for them. So then these two parties will have different objectives. So then we have to manage all these objectives. We call it the agency problem. Okay. So what it means is that as a shareholders, all you want is to maximize your profit. That's all you want. Okay, to maximize your profit. And then the manager themselves also want to maximize their money also, because they are salaried workers. So of course they also want to maximize. So therefore, sometimes maybe among the top management, right, they want to declare like high bonuses or high incentive for their own. So then you have this kind of situation. The managers who run the business, they want to have huge incentives for themselves. And when they have huge incentives, that means what? That means that the company will have less profit. Then the shareholders will not be happy. Okay, so then we need to mitigate all these agency problems. Okay, so this is what it says here. You need to mitigate all these problems. Then the next slide is the financial intermediaries. Last year we talked about banking and the financial intermediaries, right? So what this slide is telling you is that all these commercial banks, financial institutions, they are all the middlemen. They are the middlemen that act as a middleman between the lenders and the borrower. Okay, so this one I'm sure you know already. And these are the different types of the middlemen. Okay, all this we have done last year. So then the next one is talking about the investment managers who and manage money of several investors. So basically you have investment managers and then you have the investment bankers. So investment managers are mostly like the stock brokerage companies, whereby they just gather the pool of the investors together. Like all the investors, they buy and sell shares from the brokerage house. And then the investment bankers will be the bigger one, like JP Morgan, Morgan Stanley. In Malaysia, we have the merchant banks, okay, all the CIMB merchant banks and all this, that they can issue IPO. So they will in charge of the primary market transaction, whereby they can help company to issue IPO. Okay, let me charge my phone. Okay. So then, so this is what it means here. Financial intermediaries also include the merchant banks as well. Okay, and then the merchant bankers in charge of the Okay, so we go on to the next slide. The next slide is slide number 12. Okay, slide number 12, we look at the investment process. Okay, investment is a process. Okay, so the big part of the process is called asset allocation. How you allocate your money, how you allocate your capital, you have a sum of money, 10K, you want to allocate, how you want to invest. Okay, so then this asset allocation will be looking at the percentage. Okay, percentage. Okay, sorry. So you're looking at the asset allocation to manage your money, how you're going to divide. So then you have this diagram here. Okay, how come the diagram keep disappearing? Okay, so in this diagram that you see, right, you have the equity, the bonds, and the bills. Okay, the bills means the like a money market lah. Okay, money market. Very liquid fund. So you have the bonds, the bills, and the equity. So in this diagram, 60% into equity, 30% into bonds, and then 10% into the bills. So you have this combination altogether is 100%. So you look at this combination, do you think that the person with this asset allocation, is he risk lover or risk? Is he a risk taker or risk avoid the risk? You think he is taking on more risk or avoiding the risk? 60% into equity. More than half is into equity. He's taking on more risk, right? Yes. Okay, so this person is taking on more risk. The other diagram is, I cannot show on here. Okay, the other diagram, the slide cannot show. Okay, the other diagram is, can you read for me what's the other diagram?
50% bonds.
50% bonds.
Yeah, 25% equity and bills.
Okay, so this one 50% is bond, half is in bond. So this one definitely is conservative. Okay, so therefore these two portfolio, this is what we call portfolio lah. This asset allocation is what we call portfolio. This two portfolio, you can see that person A, the first person is take on more risk. The other person take on less risk. Okay, so this is what we call portfolio. Okay. Then the next part of the investment process, we look at the security selection. How you select the security. Now, if let's say you are building a portfolio, it's all about if let's say you're not familiar in the stock market, you want to invest in the unit trust, you can also do that. So then this portfolio is about a unit trust portfolio, let's say. Then in your unit trust, in Malaysia we have a few hundreds of funds, unit trusts available for us to invest. All of this, a few hundred of funds, right? You have bond funds and then you have equity funds. Agree? Now, can you tell me which fund now in the current situation perform the best? Which fund is performing the best? Bond fund or equity fund or commodity fund, gold fund, what? Which fund is performing the best? Just tell me the answer. The people in the Zoom can also tell me the answer. Oh, you are putting your answer in the chat. I'm sorry, I didn't see your chat. Okay, Xin Yi, if you cannot join the link, can you join my FB live or my YouTube live? You go to my YouTube channel and then you join my YouTube live. Xin Yi. Okay, if you cannot join the Zoom, right, you join the YouTube live. Okay, you go to my YouTube channel, okay, Pauline Young YouTube channel, and then you can see this. The whole thing is airing live now. So some of the students, if you cannot log into the Zoom, you can go to the YouTube live. So I'm trying to see whether YouTube live is okay, and then the Zoom, is it okay? So you can have two versions. Okay. All right. So so what was my question? Okay. So which fund is the best performing fund now? Since some of you guys are investing now, right? Oh no, not yet. Okay. Which fund you think? Equity fund? Okay, common sense lah. Which one you think is good? Equity fund or bond fund? Equity fund or bond fund is good now? Just answer, any answer will do. The people in the Zoom, you can also answer in the chat. Which you think is a bond or you think it's equity? Hmm? Bond? You think it's bond? How many of you think it's bond? Because it's recession, is it? How many of you think it's equity? The answer is equity, you know. The answer is equity. You know, the stock market in the US is doing very, very well. Okay, so if your answer is equity, then my next question is which market you think is performing, best performing, and the answer is US market. So the US market is the best performing market in the world now. Okay, so that's all the money is going to the United States of America. Okay, now okay, let's continue. So then in this investment process is a security selection. So you pick the stock according to their fundamental. Okay, so in this case you pick the funds according to the fundamental. In this case usually will be the global technology funds that are performing. If you're looking at unit trust, global technology funds are performing. Okay, or China fund also performing. And they also look into the India fund as well. So all these Asian region, Asian Pacific, and also the European. Okay, the whole world equity market is actually we are recovering out from the pandemic, so we should be looking at recovery instead of another recession. Okay, so you have to get your thinking straight. Okay, it's not another recession, it's more like a recovery. Okay, so next we look into the slide 14, look into the active management and the passive management. Okay, so when you look into this active and passive, then you will actually looking at the word active means what? Actively managing the portfolio. All right, actively managing the portfolio. The other one is called passive management. That means what? That means you do not need to actively manage, you just let it run by itself. Is it possible that you have passive management? Is it possible? Yes, it is possible. Number one, technology. Through technology, because of the current technology, AI, you can let AI to do for you, right? So that's number one. And most importantly, number two is that nowadays we can have ETFs, exchange traded funds. Okay, ETFs, exchange traded funds. So exchange traded funds means that the funds, right, can be traded in the stock market. So then these exchange traded funds, the funds means that they have their own fund manager. But because it is an ETF, so the fund manager, they do not actively manage it. They do not. So what it means is that they will copy the index. So for example, I create a KLCI index. Okay, so if you create a KLCI index, that means this KLCI index has top 30 largest market cap companies in Malaysia. Okay, top 30 companies in Malaysia. So we have the Maybank, Public Bank, CIMB, we have IOI, we have all the gloves company, the top 4 gloves company, and then we have industrial companies. All these companies contain all in this top 30. So what the fund managers, a passive fund manager, what he will do, he will copy the combination. He doesn't have to stock pick. He just copy whatever the KLCI index top 30 components, right? All the stocks there. I create another fund with exactly the same combination. So I don't have to stock pick. I just copy. So therefore, do I need to manage it? I don't have to manage it. So as long as the stock 30, top 30, the companies are there, I will just have to manage this top 30. Same weighting and everything, same. Everything is the same. So then, if the KLCI index is doing well, my portfolio will be doing well as well. If they are doing bad, then my portfolio is doing bad. So as simple as that. So I don't have to manage it at all. So this is passive management. Okay. So there are different conditions. So the first one is the market. If the market is inefficient, maybe you prefer active management. If the market is inefficient. Now, what is efficient market hypothesis? Have you heard about efficient market hypothesis? No. You are accounting student or finance student? Accounting. Oh, okay. For finance student, you must know what is efficient market hypothesis. Efficient market hypothesis meaning that It's a finance theory saying that the stock market itself is a very efficient market. Okay, it's so efficient that all the information is reflected in the stock market itself. So for example, ABC company makes some big money, or ABC company lose a big client deal or whatever, all this will be reflected, and then the price will be reflected immediately. So if you are the fund manager, or if you are investor, right, you want to make money in the stock market, it's very, very difficult. So that's efficient market hypothesis. It's very difficult for you to make money in the stock market because the market itself is so efficient. Everything, information is already reflected. So there's even one story. There's a finance professor walking on the street, and then beside him there's a student beside him. Then while he was walking on the street, the student saw, "Hey professor, I saw a $50 bill on the road." Then the professor said what? Say, "Oh, don't bother. If it's a real $50, right, it will not be there." So this is exactly what it means in the efficient market hypothesis. So it means that if you see a profit there, right, another person will have, it's so efficient that another person will already grab away the profit. It's not for you to grab it. Okay, so this is efficient. So, but I believe the whole world's market is inefficient, okay, to a certain extent. There are certain market is very, very inefficient. There are certain market is slightly inefficient. So the US market is slightly inefficient. So they are all inefficient, but to a different degree. So then how you want to make money is your active management. In order to make money in the stock market, you have to be actively looking for the undervalued stocks. Okay, so then this explains why fund managers, certain funds, they can perform so well because they are actively managing it. Okay, so for the passive management, it's an efficient market, you just let it run, you don't have to manage it. Then security selection. So for active management, you have to always looking for undervalued stocks. For the passive management, don't bother. Okay, and then for asset allocation, you always go for the timing, the market timing, when to buy, when to sell. But for the passive management, you just copy the KLCI index, no need to look for the timing. Okay, so all these are the differences. Next, we look into the types of the asset classes. So we have the fixed income, the equity, and the derivatives market. So now we talk about the fixed income first. So the fixed income, we have the money market and the capital market. Anything below 1 year, that instrument like the treasury bills, anything below 1 year is in the money market. Anything above 1 year, you can be traded in the stock market, which is the capital market. Okay. So we have the fixed income market. We have short term. Characteristics is that it is short term, liquid, very liquid, highly liquid, and then low risk. And then it has to be large denomination. Large denomination meaning that when you buy these bonds, right, it has to be huge, like 1 million like that. You buy the bond, it's not like 1,000, 2,000 ringgit. It's like 1 million, 2 million. You know, this kind of a denomination to buy the bonds, especially the government bonds and the corporate bonds also. Then the money market. These are the slide number 18. Slide number 18 gives you the picture of the treasury bills and what the characteristics are. So the treasury bills usually issued by the federal government, okay, which is the government bank negara, and the denomination is in 10,000, 1,000. Usually in Malaysia it's about 750,000 minimum. 750,000 minimum. I'm not sure whether you have 500,000, but anyway, it's a big amount denomination. Then the maturity, you have 4 weeks, 13 weeks, 26 weeks, 52 weeks. 52 weeks is 1 year. So anything less than 1 year is the maturity date for the treasury bills. So you look at the word treasury bills, and then you have the treasury, the whole, because this book, right, this book is US based, and the CFA exam also US based. So therefore, your chapters all American related, US related. So this treasury bills is also from the US, the federal, they call it the Fed. they issue the treasury bills. Then in the US, right, they have the treasury bills, they have the treasury notes and the bonds, treasury bonds. So the difference is that the bills will be below 2 years. Okay, below 2 years, let's type here. Below 2 years will be the bills. Okay, below 2 years will be the bills. And then from 2 years to 8 years will be the notes. We call it the treasury notes. And then more than 8 years, we call it the bonds, treasury bonds. Okay, so these are the terms. Okay, so and then the default risk is almost none. I wouldn't say none because some country like Argentina and Venezuela, these two countries currently they have a very high default risk because these two countries their debt is very high and then their interest rate is very high, 30%. So therefore these two countries have a very high default risk. So it depends on the country, okay, the issuer. So in this case, if it's the US, the default rate is very low because US can always print money. Always remember, US and China, okay, these are the two major economies in the world. They print a lot of money. And then when they print a lot of money, but in theory, it's supposed to depreciate your currency, right? But they never depreciate their currency because it's a trust that people trust in their currency. It's a big country, so people trust in their country. If Malaysia, we print money, what happened? Straight away depreciate. We are a small country, understand? Developing country. So Venezuela and Argentina, they print money, what happened? Depreciate. Okay? Then we have the interest type is the discount. Discount meaning that currently, for example, the face value is 1,000. So now you are paying 600 ringgit. So you are paying at a discount so that in the future you can get back the 1,000. So then they are issuing at a discount. And then taxation. Okay. So all this taxation is the US related tax rate. Okay. Okay, then the next one is certificate of deposit is the FD. So FD can be any amount. In Malaysia is I think minimum 5,000, right? For FD, minimum 5,000. So all these tenure you can see. Okay. So I don't want to spend too much time on this. I want to move on to the types of the money market instruments. What are the instruments? Actually, the money market instruments we have done in our last year class. So I don't want to go into too detail. So basically, these are the money market instruments, the bank acceptance, the euro dollar, the repo. The repurchase agreement is the repo. Repo is, remember, we had this one chapter on the banking settlements. Banking settlements whereby they settle overnight checks. Every night the banks have to settle the checks, overnight settlements. And then after the settlements of the checks, right, then the banks will be ended up either in a surplus position or a deficit position, remember? So if your bank is in a surplus position, then what do? You can lend the money to the other bank with a deficit position. So then this lending, borrowing and lending is through the repo, repurchase agreement. So it's 1 day loan, okay, repo. You have the reverse repo means you are lending the money, okay. So next, we talk about the calculation, the bond equivalent yield. So this slide is important because you need to know the calculations for this course. A lot of calculations you need to memorize the formula. So the yield here is called the bond equivalent yield, and then compared to the effective annual yield. Okay, these two things here. One is bond equivalent yield, the other one is called effective annual yield. Okay, so what is the difference? We don't look at the formula first, we look at the concept first. We need to understand what's the difference. The word, sometimes you see from the newspaper, you browse through the newspaper, you see that, oh, RHB Bank is offering 5% of interest rate for or 12% of interest rate for 3 months or whatever, something like that. Okay, for 3 months you can get 12% or 5%, this kind of thing. Then in the bracket it says effective rate is how many percent? Okay, so what do you mean by effective rate? So this deal is offering you for 3 months, you can get a return of 5%, let's say. But in a effective rate, it become like maybe 3%. So what does that mean? That means that effective means that you want to calculate in terms of the 1 year. Effectively 1 year, how much is the yield? Okay, so the key word here is that because this rate is offering you for 3 months only. So if you, let's say you want to calculate until 1 whole year, right? Isn't it you want to make a compounding effect? Every 3 months compound, every 3 months compound, then you can get that effective rate of 1 whole year. So therefore, whenever you see the word effective, there's an element of compounding effect inside. Okay, so everybody, you have to write down. Whenever you see effective rate, there's an element of compounding effect. There's an element of compounding effect there. So whenever you see that the credit card company, they charge you certain percentage of your credit card bill, and then there's effectively is 100%. Okay, so they may charge you 3% per month on a per month basis, but effectively it's 20%. Okay, so that's a compounding effect there. Okay, so that's effective annual yield. Then the other one, equivalent yield. Equivalent yield means what? It's just the bond yield. Okay, now with this formula. So you need to use this formula to calculate the 1 year yield for the bond, because you know that all the treasury bills is below 1 year, like 90 days, 180 days, or 360 days. It's below 1 year. So in order to make it up into 1 whole year yield, so you have to use this formula so that you can translate the yield into 1 year. Okay, and this thing doesn't have a compounding effect. Okay, so you look at this formula is using your face value minus your price, the bond price that you pay, divided by the bond price, times 365 divided by the number of duration, the number of days to maturity. So this is a formula. Then you have to memorize the formula. Whereas the other effective annual yield, the formula is 1 plus face value minus the bond price divided by the bond price to the power of 365 divided by the number of days of that bond minus 1. Okay, so this formula you have to memorize. Okay, then you look at the small picture over there. You see compare, the bond yield is 5%, the bond equivalent yield is 5.13%, and the effective annual yield is 5.23%. Okay, so among this yield, effective annual yield and the bond equivalent yield, which one is higher yield? Which one can give you a higher yield? Is it the effective annual yield or the bond equivalent yield? What do you think? Which one can give you higher yield? Effective or equivalent yield? Effective, right? Because of the compounding effect. Yes. Okay, it's a compounding effect that create the extra yield there. So you can see that when you compare effective annual yield and the bond equivalent yield, the effective annual yield is higher because of the compounding effect. That's why I asked you guys to take note of the compounding there, because it makes a difference. Okay, so the calculation will be higher in terms of the yield. Okay. Then this instrument, this one you will read on your own. I want to skip on to the bond capital market. Okay, bond capital market meaning that more than 1 year, then you will be traded in the exchange market, the bond market. Now, the bond market has its own bond market, the buying and selling. It's like the share market, but it's a bond market. They have their own buying and selling of the bond market. So then, in this in this slide, right, slide number 27, we look at the government issues, right? Government issues, you have bonds and notes. You can issue notes and then you can issue bonds. So can I ask you what's the difference between notes and the bonds? What's the difference between the notes and the bonds? The notes will be shorter, right? Shorter duration, 2 to 8 years. Then the bonds will be 10-year, 20-year, 30-year bond. Okay. Then the denomination, it could be in terms of US dollar, it could be in terms of Japanese yen, it could be in terms of the Malaysian ringgit. Okay, if Malaysian ringgit were to borrow money from Japan, the Yankee, we call it the samurai bond. If we were to borrow money from Japan, the samurai bond, what happened? It will be denominated in yen. If we borrow money from US, the Yankee bond, then it will be denominated in US dollar. So now, if we borrow money from overseas, right, what's the risk? The risk will be the exchange rate. Okay, the exchange rate, because our money will depreciate or appreciate. So, but in developing countries, right, our currencies most likely depreciate more than appreciate, most likely. Okay, because we are a developing country. We can't fight with those, those developed countries. Okay, so that's a disadvantage. The next one is the Treasury Inflation Protected Securities, TIPS. TIPS, okay? Treasury Inflation Protected Securities. So this kind of bond instrument, their yield is inflation adjusted, automatically inflation adjusted. So if let's say inflation increase, right, then their yield will also increase. Okay, so this one is the US bond instrument. We can't find in Malaysia. It's a US bond instrument. It's called TIPS. Treasury Inflation Protected Securities. So for those of you who buy it into TIPS, that means you are protected against the inflation. And this inflation will be the CPI level, which is now the CPI is like 0. Some countries even have a negative CPI. It's very low. Okay, deflation because of recession. Okay, when we are in a recession, we should definitely have a very low price level. Okay. Okay. Now the next one is called the municipal bond. In US, right? Each of the local government, like different states, there are 51 states in the US, 50 or 51. In Malaysia, we have 13 states. So each of the states, right, they can issue their own bonds. Okay, we call it the municipal bonds. So these municipal bonds, right, is issued by their own local government, and then they each have their own risk. Okay, so the risk will be individual as well. Issuer will be their own individual local states government. The risk will be their own risk. For example, Johor maybe have a huge budget surplus. Therefore, our default rate is very low. Let's say Malacca has a very huge default rate because they have a huge debt, let's say. Okay, so each government, they have their own credit rating as well. Then the next one is called General Obligation. GO stands for General Obligation. Okay, you spell out General Obligation. General Obligation is just a normal bond. Okay, obligation, that means the municipal government is promised to pay you back. That's the obligation to pay you back. Okay, just a general bond. The other one is called revenue bond. Revenue bond means that this bond is tied to a stream of revenue for this bond to be issued. For example, you want to build a highway. So you want to build a highway, then therefore the revenue from the highway will fund for this bond. Understand? Okay, so money that you collect from the bond, issuing the bond, right, will fund for this highway, and when you make money, you pay back this bond. Okay, so then this revenue meaning that you will attach to a revenue stream. It could be a highway, toll, infrastructure, or school, or whatever. There's a purpose behind it. You raise the bond. There's a purpose behind it. Okay, now the time is up. The students are waiting outside. So we want to do, because I know that it is impossible for me to finish. My plan was to finish chapter 1 and 2 today and then finish 3 on Wednesday tomorrow, but that is impossible. So therefore, I'm going to give an extra class on the Saturday. Okay, Saturday. So is Saturday afternoon okay for you guys? I will ask in the WhatsApp group, and then whatever we cannot cover by tomorrow, we will cover by Saturday, so that we finish the whole 3 chapters by this week, and then we can move on to next week. Okay, so okay, so see you tomorrow. Okay. Go to bed. Are you sure that you want to stop streaming? Yes.